Ron Diamond is a person who prioritizes people and relationships and not numbers, even though the numbers of some of his clients are pretty staggering. Hi, I'm Dave Price. Ron is the founder and chairman of Diamond Wealth. His firm counsels dozens of family offices, these wealthy individuals or families, and he guides them in their investment and philanthropic endeavors. In our conversation this week, we will find out why Ron is so optimistic about the country's future, why he is concerned about the growing gap between people like his clients and most other people, and why he is hopeful that an opportunity in 2026 could lead to developments that could benefit agricultural communities in rural America. We have so much to discuss with him, including how he answered my question about what his clients talk to him about most. Hint, it is not money. First, let's get to know Ron. Well, hello, and we appreciate the time. Thanks for joining us.
Thank you for having me. Pleasure to be here.
Hey, for the first time guests, we like to get to know you a little bit. Can you talk about how you got to where you are?
It's always a very long story. Yeah, real brief. So I graduated from Northwestern in 1987 with a degree in economics. My first job was actually at Drexel Burnham, which was where Michael Milken worked, and it was the most profitable firm on Wall Street. And
Good start.
2 years, well, it was a great start until it wasn't. 2 years later, the
Exactly.
company went bankrupt. And I remember I was in the room when it's imprinted on me. I remember when Fred Joseph, the CEO, said we're going bankrupt. I'm 25 years old. I just lost a good job. I didn't have stock options and I didn't lose money, whatever. I'm watching men, typically men in their 60s and 70s, typically openly weep. And that didn't happen in 1990. I remember fragrances. I remember the woman with the big pin. I remember an overweight person sweating. I remember it it imprinted on me. But my takeaway from that, the reason I bring this up, it it forced me to rethink things. And my takeaway was I would always be loyal to people, but I would never be loyal to a company.
Hmm.
Because if this was like Goldman Sachs on steroids, I mean, going bankrupt. And so and fast forward, you look at what happened to Bear Stearns and Lehman Brothers and DLJ and Salomon Brothers, and you can go down the list. I moved back to Chicago, bit disillusioned, very upset, and started a hedge fund before I really knew what I was doing. I raised $2 million from friends and family in increments of 50 and $100,000. Now, the good part about it is, and I think luck plays a role in any entrepreneur's life, whether they admit it or not, and I'm very cognizant of that. The 90s was a pretty good market, and we were pretty good at picking stocks. So we had a lot of tailwind, and I grew it from 2 million to about $300 million. And we never had huge returns, but we beat the S&P every year, and our clients were, they didn't call them family offices back then, they called them rich people, and now they call them
Hmm.
family offices. And I sold the company to a market neutral firm, uh, stayed on board for 6 months, and kept all the assets that got my liquidity and started investing. And what I did and what I do is I put together a syndicate. I've got about 125 families. These are family offices, anywhere between 250 million to 30 billion. And we invest together in the private markets. That's private equity, venture capital. We do a lot in real estate. And but we don't charge anything. But I'm not doing it for selfless reasons. I do it selfishly because I don't have enough capital to put in 50 to $100 million per deal. Now I do. So I call it first call alpha. So that's the main thing that I do. Second thing is I sit on some advisory boards. Third thing is I put together a family office initiative at Stanford, and now I help to do one at University of Chicago Booth. And fourth, I run the family or help to run the family office program at Tiger 21. So that's the four buckets that I play in.
Could you describe, looking back at that experience when you decided you were going to be loyal to people and not to a company, explain a little bit more if you would. So, how do you carry that out in principle?
It's a good question. And again, I didn't consider I had no plans on starting my own company or starting my own hedge fund. I was going to just work for Drexel. I think I was just my takeaway was that like Drexel was Drexel. I mean, it was the most profitable firm on Wall Street. And And there was rumors that it might go under and what, but the company said, no, it's fine, it's fine. And again, I'm 25 years old at the
Yeah.
time, and I don't know. But I, and it's been the biggest benefit for me in my career is that, my loyalty to people, and not necessarily to a company, because everything that I do is based on relationships. And in the family office world, it's 100% relationship business. So you're going to work with family offices. The first, second, third thing they want to know is, can I trust you? Who are you?
Hmm.
And the fourth thing is, all right, what's your track record, et cetera. Working with institutions, it's flipped. They look at it from the standpoint of what's your 1, 3, 5 year track record, what's this, what's that, and then they'll maybe do a little diligence about you as a person. I look at the world through the lens of just people. You're working with people, and because what is a company? It's a bunch of people, and so that's really what resonated mostly with me. And again, stay extraordinarily loyal. My accountant, the guy's name is Saul. Um, when my taxes are close to being due, he calls me all stressed out.
Hmm.
Now, I want to work with somebody like that because if I have to calm him down. But if he's that concerned about me because that he gets stressed out and I have to, that's somebody I want to work with. He's a phenomenal accountant. Are there better accountants? There might be better accountants in the country. I don't know. But that transcends anything. And I found in business that, in an idea, you underwrite to something, you're investing in real estate, you think it's going to do this. Nothing ever goes like this. It just doesn't. The key for me is with relationships is what happens when something goes wrong. When something is going well, everybody can give you a high five and tell you you're great, etc. What happens if it doesn't go right? And that's where relationships key, and that's where character matters, and that's why it's so fundamental to everything that I do. I
I've
will
cut.
not like I used to think to me right now intelligence is a commodity, integrity is not, and I didn't think that before.
Mm. I've covered politics for a long time, and as I'm listening to you, I'm thinking about when Mitt Romney ran for president, and he got beat up for saying that corporations are people too. And uh, I'm wondering what your experiences are. Are more people like you and share your philosophy, or do you have to seek them out as to what I always wonder, in these relationships, do people value the people to people side of it? That's sort of personal relationships. Or do you find yourself that you're more unique and in the minority?
Well, I would love to say I'm in the majority, but I think I'm in the minority
That's what
because
I
I think
wonder.
most people are wired are what can I get?
Hmm.
What can you give me? I
Hmm.
mean, when I was younger, I was certainly more transactional. When I go to a meeting with somebody, I don't have an agenda. I want to learn. I want to listen. I want to and people were pretty good at listening. We're not great at listening. People in general. I'm getting much better at it. Um, I think that you just really have to understand what you're looking that at the end of the day, I do care about the result, but the intent is the most important thing. If I get a great return and the broker still took more than he was supposed to, I'm not happy.
Sure.
And if I get a little less return, but the broker did everything he was supposed to do, I would rather do that investment. And I
When I,
think that, again, I think that we live in a society where people want to get stuff. What can I get from you? Every time, everybody I meet with, because I've got access to, 125 billionaires. How can I get this? I mean, I was at a conference in New York, I don't know, 2 years ago. I'm with a guy that I know fairly well. And I'm at a conference. I was keynoting the conference. And then it was before we were having cocktails. And then I said, "Oh, I saw somebody else that said you guys should talk because I needed to get ready to speak." They spoke, and then after my speech, the guy came up to me and goes, "Why did you introduce me to him?" I go, "What are you talking about? He's a nice guy. I don't know." He's like, "Well, he's not going to invest with me."
hmm.
And then I'm like, "Okay, look, I didn't come to this conference for the purpose of raising money for you." And I think we live in a society where everyone's looking to get. And I can't explain it logically, but there's a book called The Go-Giver, which I'm a big fan of. But it's not logical, it's not intuitive, but the more you give, the more you get. I wouldn't think that when I'm 25, but now I'm 60. It's true, but you have to live that to understand it.
When I was reading through your bio before we connected here, and tell me if this is still accurate, do you sit on 10 different advisory boards?
Yeah. So yeah.
That seems like a lot. How do you divide up your capacity?
So, well, remember I love the advisory. I love advisory boards. So the way I'm able to do it, first of all, advisory boards typically meet quarterly,
Okay.
and now because of COVID, most of them meet via Zoom. So there's not the travel. So it sounds like a lot, but if it's an hour and a half meeting once a quarter via Zoom,
Okay.
it's not that heavy. It's not as heavy a lift as you think.
Okay. Okay, so as we start looking ahead to 2026, what are you looking at? I'm especially curious how you view the American economy and where we're headed.
It's a great question. I think, look, I think that we have an administration that wants to do anything they can to keep interest rates down and to make the stock market work. And they're very upfront about that. Um, so I think if that's driving it, I mean, in general, I'm extremely optimistic about this country. I mean, 70% of the time the markets go up. And then when you go deeper and you look at what asset classes, I mean, real estate to me is very attractive. And I mean, multifamily real, you could buy stuff cheaper than replacement cost now.
Mhm.
And again, I've never bought anything at the bottom. I've never sold anything at the exact top. I try to stay between the 820 airlines, but it seems like it's a pretty good time to get involved in this because it's multifamily has been hit pretty bad, and a lot of real estate has been hit pretty bad. What happened was a lot of family offices they did direct deals, and basically the thought process was post crash, pre-COVID. I don't care what you invested in, you made money. I mean, interest rates are zero. I'm not saying it's easy, but it's certainly easier to make money with interest rates at zero, certainly in real estate. So people were like, why should I pay somebody a fee if I could do it direct and make money? And they were right until they were wrong. And
Hmm.
then 3 years ago, they jacked up interest rates. And now you've got a lot of family offices that are in way over their skis that own real estate assets that are going to have to give it back to the bank or going to have to refinance and they don't know what to do. And I think there's going to be a pushback. So I think there's good opportunity. But I always try to surround myself with people that I trust implicitly, that are smarter than me in anything we do. And if I trust them implicitly and they're best in class in what they do, that's the person I want to work with. If they're best in class in what they do and I think they're, you know, I'm not going to work with them. I need to know what's going to happen if something goes wrong. Because I start with, even though I'm an optimist and glass is half full, I start with the premise and every reinvestment I make is what happens if it doesn't work? What's the downside and how's this partner going to play out?
Most of the folks you work with in these family offices, are they the kind of 50 plus crowd or do you have younger folks? And there's a reason I'm asking you this to
It's
follow up.
both because with family office, remember, you've got there's $10 trillion in capital in family offices, but you've got 124 trillion that's moving downstream from the baby boomers to the next gen.
That's
So
what I
you've got
want
the
to get to.
largest transfer of wealth in history. So by definition, a lot of that wealth is being transferred. So by definition, a lot of these people will be younger.
And the reason I ask, I guess, is that I'm curious if you have to counsel folks when you just mentioned interest rates, and maybe for the younger ones who experienced zeros when they really started getting into this, it's not like we're crazy high. Sure, compared to zero, we are, but for those who remember not that long ago, this is more the norm, and I'm curious how those discussions go, and if it's an age-related thing.
It is. I mean, because again, I'm dealing with some people who are in their early 30s and all they knew is things that kind of went like straight up
Yeah.
and interest rates real low. They're like, interest rates are crazy. Like, what interest rates were when Carter was president?
Yeah.
So it's relative. I mean, they understand that these are very bright, sophisticated people, and typically they have the family offices that are over a billion. They typically have teams of people, so it's not like I just have to convince one person.
Sure.
4% is not a crazy interest rate, or 5% is not a crazy interest rate. keep it in perspective.
Okay, would you now talk, and I didn't mean to cut your thought off, but the wealth transfer from boomers to whomever's going to get it, what will that be like?
Well, first of all, it's going to be the largest transfer of wealth in the history of the world, okay? Which is massive. And there will be some good and some bad that comes out of it. The good, I think, the we're the problem right now is the wealthy are getting wealthier and the poor are getting poorer, and the middle class is going down. And even though, you know, I invest with a lot of very wealthy people, it's not good for society for the rich to get richer and the poor to get poorer. It's just without a sustainable middle class, bad things happen historically in any society. Having said that, why I'm optimistic is that I kind of my North Star. Most of these families, remember, they're families. It's not a private equity firm, which only looks at numbers. These are families, and families have people, and people have concerns and passions and cares. So you might have kids who are concerned about the climate. You might have people who are concerned about education, or what you name the cause. What I'm optimistic about is I think that this next generation, it's not that they're more thoughtful than we when I was a kid. It's just I didn't have the internet. I didn't have a phone. So my daughter, I when I was 18, if I buy a pair of jeans, if they fit me, I'd buy them. If they didn't, I wouldn't buy them.
Mhm.
My daughters, they have to fit, but then they look up at their phone. Who makes them? How do they treat their employee? And they can get access to that. I had the Encyclopedia Britannica. So you got so the technology has come into play. So they understand a lot more. And kind of my North Star and what I love about the family office space, it's not rich people getting richer because hoarding money, there's no value, there's no societal value in just rich people getting richer. The value to me is my dad passed, who's my hero, passed from prostate cancer at 57. And at the exact, right around the same time, Michael Milken, who was my first boss, developed prostate cancer. So what my dad did is what I would do, what most people would do is you go to two, three, four, the best doctors you can, and you do everything you can. And he lived 4 years and then he passed. What Milken did is he did that, but he's a visionary financier, and he also built it like a venture capital fund. In other words, he had prostate cancer. So in addition to going to the doctors, he's like, I'm going to put $2 million into this crazy idea, 250,000 here, 5,000, 100,000 here, 2 million here, up to $100 million. As a result of Michael Milken, me, you, the male listeners will pass with, but not of prostate cancer. Fast forward 30 years, irrespective of what you think of Bill Gates, I would argue he did more for COVID than the US government. Eric Lefkowski started a company, a multi-billion-dollar company, Tempest, not to make money. His wife had breast cancer, and he didn't like the data, so he tried to solve for that. And then as a result of that, a multi-billion-dollar company, and then Sergey Brin has a predisposition for pancreatic cancer, and he's donated $1 billion. Is he going to solve it? I don't know, but I put my money on him over the American Cancer Society. So my North Star is that I don't think it's a panacea, but I do think that family offices are going to solve a lot of these real world problems because my mom's got dementia, so dementia impacts me. My dad passed from prostate cancer. That impacts me. Everyone's got something. It doesn't matter. And if you're passionate about it and you've got the means to do it, but you also have the entrepreneurial way to run it. You can't run a charity or philanthropy exactly like a business, but what's happening is more and more of these people are running it more like a business. And as a result of that, it's going to be more effective. I don't think a lot of these solutions are going to come from the government. They're not good at that. I don't think it's going to come from corporate. I think many of them are going to come from family offices, and that's why I'm so optimistic.
And based on your background of being kind of a people guy and a people to person to person guy, are most of these folks you deal with, are they inclined to believe as you do and essentially using their wealth for good?
Not all, but most. And again, I don't judge anybody. I mean, look,
Yeah.
you sell your widget company for $1 billion. You don't want to give it away. I don't say you should give 10. I don't judge anybody.
Hmm.
I think that what happens is that in life, that as you get older, you tend to attract people more like you. So I think that in general, most of the people that I'm working with, not all, but most of them have similar value. Now I trust them all implicitly, that 100%, but most of them are philanthropic. And some of them are very philanthropic. And I think that's just the way you're going to attract people who are kind of like you, whether for good, better or worse. And that's kind of, I think, what's how it's played out.
Uh, as we talked before we started recording, I'm coming to you from essentially the middle of Iowa, and Iowa has some, not compared to Chicago, but it has some larger communities, if you will, mid-sized probably realistically, but most of the state is very small, right? A lot of very small communities, similar to some of these other states, especially across the Midwest. And I'm curious if you think the future of these smaller communities, will it take outside investors to be the ones to create something? Just specifically for Iowa, for example, about two-thirds of the state's counties have shrunk over the last really 50, 60 years. I mean,
Yeah.
it's just this long slide, which is not sustainable, clearly. And I'm wondering, as you sort of look across the entire country and really globally, as you're involved in so many things, like where's the future for these smaller communities? Is it outside investment? Does it have to be solved on their own? What's the future?
I think it's going to be outside investment, and I think what's happening is they're creating these rural opportunity zones right now, and that's incenting people to invest in more rural areas. And I think that's going to be the driver. So in 26, there's going to be a new batch of opportunity zones that come out, and there's specific ones for rural where you're getting a 30% discount versus a
Hmm.
15% discount in a regular opportunity zone. So it's driving it. So I think the people who run the country understand that it's not good if all these little places in Iowa and small cities go under. How do you solve for that? Well, you have to bring in money, and how do you solve that? Figure out ways to make it advantageous from a tax standpoint. So that's to me what's going to drive it is these opportunity zones, and then once that happens, once money starts coming in, then I think the communities can pick up. But that's going to be the driver.
Of your family offices, what is the interest level specifically in agriculture?
We do. I would say it's pretty good. It's not a huge component of what we do, but remember, agriculture is it's important because families look at things not how's this going to do in 3 to 5 years. They look at things over generations, and I think a lot of agriculture, farmland is a multi-generational thing. Here's the problem today with the world that we live in from how companies are financed. If a garage door company in Des Moines, Iowa, where you're based, gets sold and gets purchased by a private equity firm, I could tell you approximately when they're going to get bought, when they're going to sell. Not because I'm so smart, but because I know how they're compensated. Charlie Munger said, "Show me the compensation, I'll show you the result." They're going to sell it in about 5 years. They're going to sometimes sell it to a strategic, but typically to a second private equity firm. They're going to hold it probably about 5 years because that's how they're compensated. So if you look over the course of 20 years, this garage door company in Des Moines is going to probably change hands 4 or 5, let's call it 4 times. If you look at the taxes and the friction and the inefficiency and the disruption in business versus a family office who could buy it, hold it for 20 years and let it compound, the results aren't even close. So family offices are going to be a more likely buyer of agricultural land, which is a more long-term play. And so, yes, I like the asset class a lot.
So how does this big wealth transfer that you're talking about, how do you see that impacting agriculture?
Um, I think it's going to impact everything. I mean, look, even
Okay,
there are some farmers who are very well,
for
some of
sure.
these are who are very wealthy are going to pass things down. Unfortunately, I think that the how it's going to get passed down is the negative is the truth is the wealthy are going to continue to get wealthier and the poor are going to continue to get poor. That's a bad thing. We need to do something to figure that out. Now, I'm a capitalist and I want to do everything to make everything grow. But again, from a societal standpoint, if you want the country to do well, you want the middle class to do well. So you have to look at things. So I'm optimistic about it. I think that investing in the by incenting people with these rural opportunity zones, which is a relatively new, which is a very new phenomenon, that's really what's going to drive it. Because I think people are smart enough to know that it's not great if 1% of the population is doing everything and
Hmm.
99% can't or 50% can't afford groceries. That's not good for society. So I think that we're at a point where there's going to be a change, and I think that the in your area specifically in the rural areas, the opportunity zones is what's going to drive it.
And this might be too soon to ask, but do you see a specific focus yet on what they would do in these opportunity zones?
It doesn't matter because once something is an opportunity, you can start a manufacturer, you can start a venture capital
Hmm.
firm.
Hmm.
So it doesn't matter what you start, you've got the tax benefit. So ta family offices, I think the difference, people always say, well, what's it like working and investing with family office? The only difference with working with family office, investing with family office and regular or ultra high net worth people, they're super, super, super aware of the tax code, and they're super, super tax sensitive. They're tax aware. So I don't care if I'm invested in Citadel and it's up 20%. That is a moot point to me. I just care that after tax, it's up 12%. That's the only number that matters to me.
Hmm.
And I think what families focus on is the after-tax return. And I think you're going to see more and more of that. So tax-aware there's a firm AQR, which is a $185 billion hedge fund that is doing tax-aware. They're growing at like $3.5 billion a month because people are focused more on tax-aware investing. I think that things like ETFs, which are again a tax. So I think one of the inflection points, one of the things I think you're going to see is it's not just the wealthy, the upper middle class, the ultra high net worth individuals are going to also start working on ultra tax and after tax returns. Because at the end of the day, you've got your accountants in one room and the lawyers in one room and the other people, money managers in the other room, and they don't talk. And the only number that matters to me, I'm not an endowment, I'm a person and I pay taxes. The only number that matters to me is after tax. I think we're going to see much more focus on the after tax returns. And I think the incenting people with the 30% in the rural opportunity zones is going to be a big boom for Des Moines and for the Iowa region.
But you talk to so many people who must be picking your brain, like I am, picking your brain for insights. What do they talk to you most about right now?
Their kids. I mean, look, I think that, um, I mean, a lot of, look, we invest and that's what I do, but we talk a lot about life and things. I think that, a lot of people who are around my age, got kids in their 20s, it's a really, it's a hard time to be a kid. When I say a kid, I mean, to be in your
Young adult.
15 to 30 right now.
Hmm.
When I was done with school, what I would do is probably what you would. I'd come home. If there's one person out there, I'd shoot hoops with them. If there were three people, I'd play 2-on-2 football. If there were six, we'd play four square. We just make stuff up, and it was unstructured. The amount of anxiety, stress, depression, even suicide amongst the 18 to the younger cohort is off the chart. So a lot of what I talk about is yes, we do the business part of the investment, but it always turns back to the kids. Like how do you raise kids with gratitude and not entitlement when mom or dad or grandma, grandpa is a multi-billionaire?
Hmm.
How do you do that? And there's no playbook for that. There's no right answer for that. And I think that we're trying to solve for that. So I helped to create the Family Office Initiative at Stanford. I'm helped to create the Family Office Initiative at University of Chicago Booth. My feeling is that family offices in your world in rural Iowa, I think family offices are the best strategic partners because they don't look at an IRR. They look at things over long term and they look at things after taxes. And I think that we're going to see more and more, especially with the onset of these opportunity zones, more and more people who hadn't looked at Iowa or hadn't looked at farmland before. If now it's an opportunity zone, it was maybe attractive before, but now it's really attractive. So I think that's what's going to spur everything. So I'm very optimistic about it.
You talked about that there's no real playbook out there to instill that gratitude in our kids. So what have you personally found that works? I have a 15-year-old and a daughter who's about to turn 10, and that is something
Well,
that my friends and I have discussed that it is very
Two,
difficult to instill that.
it is two things. First of all, you say something, you do something different, they're going to do what you do, not what you say. You
Yeah.
tell them you should read books. It's really important, and they never see you read a book. They're not going to pick up a book. If you tell them you shouldn't watch TV all the time, and they see what they're going to do it. If they see me working really hard, they see that it kind of models them. They see that I'm conscious about when a busboy or a waiter or waitress sort of we make eye contact with them,
Mhm.
and they're they're not there to. I mean, they're there to help us, but they're not beneath. They're everybody's the same, and we try to instill that in our kids. It's hard, but I think the easy. It's not what you say; it's what you do, and by the way you live your life, the way you treat people, the way in which I mean, I'll give you an example. We have a thing at our house where if there's an emergency, if now my daughters are 22 and 25 right now, they're beautiful kids and they're wonderful. But when they were younger, we had a thing where if you call three times, it's an emergency. So I'm in
Mhm.
a meeting with a large multi-billion dollar family and we're talking as a real estate deal. And I get the phone rings three times and it had never happened before. And my daughter was like 7 years old and 10 years
Mm.
old. So your heart sort of sinks
Yeah,
in.
yeah.
I say I've got to leave the meeting. I leave the room. I take a deep breath. I call my daughter. I don't know if she's in the hospital. Bella, what's up? Daddy, what are the five most important things in life? I'm like, what's wrong? She goes, no, I've got an assignment that's doing like an hour.
Oh,
So the first thing I did is I had a huge sigh of relief that
yeah,
that's not an emergency.
yeah.
The second thing I did is I was pissed because I didn't explain to her what an emergency was.
Yeah.
And then I came back home and I said, we talked. I'm like, look, that's not an emergency in any event. So we did that. And then she's like, can you help me with my projects? I'm fine. So for her, she's 7 years old. It was like being popular, being a good sister, being a good listener, having a lot of candy. And I don't even remember what the fifth was, but those were the four of the five. And then she flips it on me. She goes, what are your five? I'm like, I don't know, or whatever. And then the next day she comes to me, what are your five? Like, I'll get back to you. She did it is only a kid can do. They keep hounding, and finally after
Uh-huh.
like 2 weeks, I'm like, all right, fine, I'll get you. But I didn't just say, okay, it's this, and I actually thought about it, and I talked to my wife about it. I'm like, oh, well, all right, so hers is being nice, being a good listener, being a good friend, being popular, having candy, which is a 7 year old that for her. What are my five? And in mine, and I thought about this for about a month before I told her what it was. And it was in order: love, gratitude, attitude, balance, and laughter. Now, love transcends everything. Gratitude, I think people are not good at. I think there's 10 things that suck in my life and your life and most people's lives. And there's 10 things that are great in our lives. And we're wired as a species to focus on the negative. But
Mhm.
I think that it's much better to live with an abundance mindset and to live with gratitude because there's so much we've got. It sucks that my mom's got dementia. It sucks that I lost my dad at 57. There's a lot of things that suck, but there's so much I've got to be grateful for. So I try to focus on gratitude. Your attitude, which is number three, I think is so important because your attitude is everything. How you treat people, your demeanor, etc. Um, the fourth one, balance, is one of the hardest. Certainly was one of the hardest for me, and probably one of the hardest for most type A personalities. How do I want to be with my kids all day long. I also want to grow a multi-billion dollar company. How do you balance that?
Mhm.
And it's a hard thing to do. And I don't know you never have the perfect balance, but you set standards, you set boundaries, you set guardrails. You say, okay, look, on Sundays, it's only family, period, end of conversation. On Friday nights, we're gonna have dinner together as a family. You set these rules, and so that's how I do the balance. And then the last thing, laughter. I just think there's so many things that are so screwed up in our world right now. Um, Without a sense of humor, it's hard to get through. At least it is for me. So I just think that I watch a lot of comedy, I watch a lot of satire. It's just a very important part of my life. And I try to laugh every day. If I haven't laughed, I will watch a YouTube, something that will make me laugh. So those are some people it's religion. It's different for everybody, but at least I thought it through. And I think it's important for all of us to kind of think this stuff through. So to answer your questions, I come back to, what do you guys talk about? We talk about investments, and we know we're with the families, and we group and we syndicate, and we'll invest it and do that. But conversations ultimately come down to, these are still people that I like and trust and respect, and people I want to be around. It always comes back to what's going on with the kids. What's going on with the kids? How's he? Oh, he's 13. I heard he made varsity, or 18. I heard he made varsity in basketball.
Mm-hmm.
That's really what it comes back to, because I think that's what it's all about.
Amen. Amen. Thank you so much. Really appreciate the conversation, and thanks for sharing that at the end, especially.
Well, thank you for having me. It's been a pleasure.
You can learn more about Ron by checking out our profile piece about him. It's in the weekly American Farmland Owner newsletter. It's the place where landowners get their news. It is free, comes out every week, and you can have it emailed right to your inbox if you choose. See what it is all about. Just go to AmericanFarmlandOwner.com. Thanks for joining us this week, and thanks for caring about the future of our farmland.